An 850 FICO score can exist without a big paycheck. Your salary is not a direct ingredient in the common 300 to 850 credit score range. That feels backwards, because lenders care about getting paid. The score looks at your borrowing records, then turns them into one risk number. Picture Sam with one credit card. The card limit is $1,000. The balance is $700. Every payment so far has been on time. Sam's score is built from the credit report. The report is the file. The score is the grade made from that file. The report lists credit accounts, balances, payment status, account ages, and recent applications. It is mostly about borrowed money. It usually does not directly count savings, job title, or rent. Rent can matter only if it gets reported into a credit file. So, Sam could earn $30,000 or $130,000. If the same credit facts are reported, the score math sees the same facts. The score also does not update every second. It changes when the report changes. The report changes when lenders send new information. For a credit card, that update often happens around the statement date. Sam may pay today, while the report still shows yesterday's balance. That is why credit improvement is really report improvement. You are trying to change the facts that get sent to the bureaus. For Sam, the main facts are clear. One $1,000 card, $700 reported balance, on-time payments, account age, and any new applications. Those 5 facts do not count equally. A common FICO score is roughly a recipe with 5 jars, and 2 jars are much bigger than the rest. The biggest jar is payment history, about 35%. It asks a blunt question. Did Sam pay each account by the due date? Sam has 12 on-time card payments in a row. That protects the 35% jar because lenders care most about getting paid back as agreed. The second jar is amounts owed, about 30%. For credit cards, the key piece is utilization, which means balance divided by credit limit. Sam's card shows a $1,000 limit and a $700 balance. That is 70% utilization, since 700 divided by 1,000 equals 70%. That 70% can weaken the 30% jar, even if Sam never pays late. Scores usually prefer lower reported card balances. Together, the first 2 jars are about 65%. Payment history, 35%. Amounts owed, 30%. That is why quick score work often starts in 2 places. Prevent any late mark and lower what the card reports as owed. The third jar is length of credit history, about 15%. Sam cannot make a 3-year account become 10 years old by Friday. The last 2 jars are smaller. Credit mix is about 10%, and new credit is about 10% in the common FICO breakdown. Credit mix means having experience with different account types, like a card and an installment loan. New credit means recent applications and newly opened accounts. So, Sam ranks levers by jar size. Protect every due date first, lower the $700 reported balance second, then study when that balance gets reported. Now, Sam's fastest lever is utilization. That means how much of the credit limit is showing as used when the card reports. Sam has one card with a $1,000 limit. The statement shows a $700 balance. That is 700 divided by 1,000. If Sam's utilization is 70%, scoring models usually read that card as heavily used. Now, Sam pays the card down before it reports. If the reported balance is $290, utilization becomes 29%. That's the 30% talk. It's rough, and $290 looks safer than $700. If Sam pays it down to $90 before reporting, utilization becomes 9%. Single-digit utilization can look even better in many scoring models. Here is the catch. Paying on time and reporting a low balance are separate events. The due date and statement closing date are different days. Many card issuers report the statement balance once each month, so a high grocery and gas week can show up even if Sam later pays. Example: Sam charges $700. The statement closes that night. Then Sam pays in full tomorrow. The reported balance can still be $700. Utilization also works across all cards together. Later, Sam has two cards, one $1,000 limit and one $2,000 limit. Together, the limits are $3,000. If Sam's total reported balances are $300, total utilization is 10%. So Sam checks each statement closing date, then aims for low reported balances before applications. The bill still needs to be paid by the due date. That due date feeds the biggest credit score bucket. In a common FICO score, payment history is about 35%, heavier than utilization. Sam's card bill says minimum payment, $25, due on the 12th. If Sam pays at least $25 by then, the account stays current. Paying the minimum does not avoid interest on the leftover balance. It mainly protects the payment record, which is what the score watches here. Mark the 12th, then count 30 days after the due date, around day 42. A late fee can show up earlier, depending on the card terms. Credit reporting usually starts when the payment is 30 days late. So, if Sam forgets on the 12th and pays on the 20th, that may cost a fee. The credit report usually still avoids a late mark. If Sam pays on day 45, the story changes. The account may be reported 30 days late to Equifax, Experian, and TransUnion. That's why $25 on time can beat $500 late. The promised minimum arrived before reporting. Paying $500 after the late mark still helps the real account. It can stop worse marks, like 60 days late or 90 days late. The damage can last a long time. Late payments can stay on a credit report for up to 7 years from the missed payment. For Sam, the simple defense is autopay for at least the minimum. Full payment is better for interest if the cash is there. Sam also keeps a small buffer near due dates, maybe $100 in checking. That buffer protects the $25 payment when timing gets messy. After payment history and utilization, the next pieces move slower. FICO usually gives length of credit history about 15% of the score. Sam has one card opened 2 years ago, a 24-month account on the report. If Sam opens a new card today, the new account starts at 0 months old. Now the average age changes fast. A 24-month card plus a new card averages 12 months, so Sam's file looks younger. That does not mean new cards are always bad. It means applications have a cost, especially when the score needs to look good soon. A hard inquiry may show up when a lender checks Sam for new credit. One inquiry often costs less than 5 FICO points. Hard inquiries usually stay on credit reports for 2 years. FICO scoring generally counts them for 12 months. New credit is its own smaller bucket too, roughly 10%. Several applications close together can make Sam look riskier for a while. Credit mix is another roughly 10% bucket. It means experience with different account types, like credit cards and installment loans. A credit card is revolving because the balance can go up and down. A car loan or student loan is installment debt. Opening debt only to improve mix can add interest, fees, and missed payment risk. A $500 loan can cost more than the score bump is worth. For Sam, the quiet move is simple. Avoid extra applications, keep useful old no-fee accounts open, and let clean history age. Sam's plan is boring on purpose. Skip new credit and fix what scores read first. Sam has a $1,000 credit limit and a $700 balance when the statement closes. That reports a 70% utilization, which is high. The first target is under 30% reported utilization. On a $1,000 limit, Sam wants the statement balance at $290 or less. The better short-term target is under 10% when cash allows. For Sam, that means $90 or less reported on the statement. This does not require carrying a balance. Sam can pay before the statement closes, then pay any remaining bill by the due date. Payment history still comes first. One 30-day late payment can hurt a clean file far more than a tiny utilization improvement helps. So, every account gets a due date reminder. Credit card, car loan, student loan, phone financing, everything with a reported payment needs protection. Next, Sam checks reports from Equifax, Experian, and TransUnion. In the US, annualcreditreport.com is the official free report site for consumers. Sam circles 4 errors: wrong late payment, wrong balance, duplicate account, someone else's account. If the report is inaccurate, Sam can dispute it with the Bureau. If the mark is accurate, time and clean payments matter most. This week, protect every due date and lower the balance before it reports. Credit scores move when reported facts move. Start there.